Good morning guys. Today I'm back with a new video related to the stock market. So today I'm going to discuss about an important concept which is used to assess the company's risk in the stock market. Yeah. That is none other than debt to equity ratio. In simple terms, debt to equity ratio, I mean the word itself suggests debt divided by equity. Debt is the amount of loan which is taken by the company. Either it can be either long term or short term, and equity is the total amount of equity raised by the company. Yeah. So more the debt to equity ratio, more is the risk taken by the company, more is the company leveraging. And if the debt to equity ratio is zero, then it can measure two things: either the company is well grown and it can grow forward with the help of the cash or revenue generated by the company, and or the second is the company is has reached a kind of trust state. Now from that point the company will not show much growth. It is a stable company. Probably most of the some of the nifty 50 stocks are debt free, especially in the FMCG sector. For example, ITC, HUL. Even in IT sector, Tata has negligible debt. The debt to equity ratio will be close to zero, and same with Infosys, etc. So these companies, IT sector companies, they have very good source of revenue, so they can grow in the future only with the help of their cash. So they don't require debt in order to expand their business and grow their revenue and increase their reach. Yeah. So but when we look at the manufacturing sector, for example the automobile sector or the paint sector or the chemical sector, in these cases, of course the steel is an important manufacturing entity which is taken, and the metal sector. Here the capital expenditure is very high. The company requires huge capital to start the business. Barriers of entry is very high because it requires millions of dollars of investment. So here, in order to make sure there is a proper investment and a proper expansion taking place, the company must raise the money. It can raise the money by equity, but equity is not always the answer, because how much you can raise money by equity? If the company wants to expand very fast, then debt is the easier way to earn, because in equity what will happen is, when an investor is going to invest in that particular stock, he's going to think about the company. If the company is not generating revenue, and if the company is not showing any future prospects, then it is difficult to raise the equity from the firm. But if you have good assets, for example land or other intangible assets, then easily you can take the debt or issue bonds. Yeah. And even in this COVID-19 pandemic, or in the hard times where the entire country, in fact the whole world, is in recession, the companies which have relatively low debt will survive through this recession, because the company need not have to pay the dividend. Even if there is a bad quarter, they need not have to pay the interest, right? Because they don't have debt. And even if they have low debt, then they can easily pay. So the company will not suffer a major loss. But in fact, if the debt of the company is very high, the bank holders will will not give you any opportunity. They might restructure the loan for some period, but you must maintain a certainly good amount of revenue in order to repay the debts of the company. So in this COVID-19 pandemic, or in a recession era where the sales of the goods is not happening in a right supposed manner, then it will be very hard for the company to repay the debt, right? So it is generally, if you are I mean more the debt to equity ratio, more is the risk assessed with the stock. And obviously when there is more risk associated with any particular stock or any investment, then normally it is it is normally stated that you'll expect more return from investment. For example, if I what do you say think about any Adani stocks. Let us think about Adani Green. Adani Green share. First, let us look about the stock. Okay. Right now, some bad things are happening for the Adani stocks because of their foreign investors deal. Okay. So one day -4% return, then 5 days 7% return, and then 1 month the company has shown 17% negative return, and in 6 months it has shown 14% negative return. Yeah, but when you look at the long term chart pattern, the company has shown 3000 return in just 2 years of the period. In fact, at one time the total what do you say return was 4100%. So let us look at the debt to equity ratio of this stock. Might take some time because the net is slow. If I go down here, if I click on ratios, I'll get a info about the debt of the company. Yeah, debt to equity ratio. Look at the debt to equity ratio. It is 27 times. You know how high it is. You cannot even imagine. Normally, one debt to equity ratio is equal to 1 is considered fairly good. But 27 means it is a very riskier asset. Even if the company doesn't perform well for 2 or 3 quarters, then the company will be in a pretty much bad phase because it has to repay a huge amount of debt every quarter or every month. So this shows how risk the company is, and the debt to equity ratio is what do you say not stagnant. It has increased rapidly from 3 to 27 20, almost 9 times or 8 times within a period of 5 years. You know how riskier that is. So the debt to equity ratio has increased, so is the riskiness or the beta of the stock, so is the stock returns. Here I'm not saying the debt to equity ratio increase will have a direct will increase the stock price. It means the stock is going towards the riskier position. So in case of any slight problem issue the company, for example, if the laborers go on strike or any other macro issues about the solar cells, or if their manufacturing unit catches fire, then it is going to cause more harm to Adani Green because they have taken huge amount of debt and they have to pay it back every month. Yeah, and the main reason why this Adani Green, people are respecting Adani Green, and the stock has been performing very well in the past few months or in the past year, is that all the investors who are investing right now are focusing a decade from now, a decade of growth in the solar investment field, because India has set a target of manufacturing around 500 gigawatts or 250 gigawatts or 300 gigawatts, I'm not sure about the data, by the end of 2025. And this solar investment is going to increase over the future, and Adani Green has the early advantage, which gives a little more premium to the stock. But now, one weakness of the stock is another major player which has good cash and which has disrupted the telecom market in the past is entering, which is Mukesh Ambani's Reliance company. It is going to invest some 70,000 crores in the solar sector, and it is going to manufacturing solar panels, which is good for India because more is the perfect competition in India. Then if more manufacturers come and start manufacturing the product, obviously the cost or the price of the product will decrease. If the price of the product will decrease, obviously the quantity will decrease based on. So it is just a kind of a perfectly competitive market if you have studied this topic in the CFA level 1 term. And obviously if the manufacturers increase, then if the supply is greater than demand in the domestic market, all these manufacturers will try to explore the foreign market as well, and they can give a good competition to China in the future, because China is right now dominating in the solar cells and the battery manufacturing units. So let us see what happens. And Tata has said that it is going to enter into the battery manufacturing plant, because and it has it has been said that it has been in talks with the Bolivia government to extract lithium from the lithium triangle, and Tata Chemicals will be manufacturing lithium-ion batteries. And this is such a speculation. There is no concrete, what do you say, structure or a plan which has been given by the Tata Chemicals to its investors. So let's wait and watch how the thing unravels up. Yeah, this is all I wanted to say today. I take leave. Thank you guys. Goodbye. Jai Hind.